So, for our final panel session of the morning, we're almost at that time, we once again turn the focus back on allocators with a dedicated public pensions panel titled, Show Me the Alpha, a demand many fund managers in the room will be doubtlessly familiar with. So please join me in welcoming to the stage today's moderator, Alicia McElhenney, Senior Reporter at Institutional Investors, and her four panelists. We have John Clace, CEO of Alborn, Jose Mondu, Chief Investment Officer of the Canadian Medical Protective Association, Ronald Parker, President and CEO of the National Association of Securities Professionals, and Mario Terron, Head of Investment Funds and External Management at CDPQ.
Hi, everyone. Thanks for taking the time to join us right before lunch. Let's get started. I think we can all agree that capturing alpha in 2023 will be much more challenging than it's been in years past, but it's not going to be impossible. Today's panelists are an accomplished group of industry leaders who will share their perspectives on how pension funds can still make it happen, with a special focus on hedge funds and, of course, private markets. We're going to start with asset allocation and the role that hedge funds play in the portfolio today. I'll toss it over to John to get started on that.
Okay, great. Well, we obviously see hedge funds playing a broad role in allocations in the current pension plan market. I think when in our sort of prep call, we're talking about kind of how do the sort of target allocations impact how people are using hedge funds. And clearly, hedge funds are not an asset class, but a business model. And for such a long time, you can see hedge funds being used either as capital preservation or capital appreciation assets. I think the majority of pension plans are really looking for diversification. I think it's great to be on a panel talking about hedge funds at a time coming off one of the highest alpha years for the hedge fund marketplace, certainly in the since the financial crisis. And so thinking about the kind of the role at this point in time, it's interesting is when you look at targets. We have a lot of investors who last year, because of the denominator effect, their hedge fund portfolios performed very well, and but also had liquidity. When you're looking across some pension plan portfolios, the challenge with we've been talked in maybe in the other rooms about in private markets about the marks on private market portfolios, but for the hedge fund portfolios that have made money and preserved capital as a source of liquidity in the last year. But that's actually been a really fantastic dynamic for those investors who maybe haven't been invested in hedge funds for as long, because it's a source of then capacity to be able to build out really high quality programs. So yeah, and then the actual performance, what's interesting is when you look at strategies, there was a panel I caught a short part of earlier, and certainly the best performing strategies around the kind of macro and systematic macro space have driven performance. They also offer some of the best liquidity. So that's the area where certainly some investors we're seeing taking profits in order to rebalance. And I think this was an interesting year in terms of performance for hedge funds when you're looking at across portfolios, because actually it was quite predictable in the sense of we create strategy forecasts each quarter that we update looking out 12 months, and this just sent out the State of the Union within the company and looking at the performance of our forecasts for 2022, and point estimates are always wrong, but we look at kind of positive case, central case, and negative case, and the negative case was sort of down 10%, and what we end up sort of seeing, well, it's been down 10% for S&P, and the rankings for hedge fund strategies last year were almost like spot on, like quartile-wise, almost every strategy was in line, but there was just a lot more alpha, particularly in the third quartile. So even though the S&P was down 18, you saw much better performance from a number of relative value strategies that you might have expected to participate a little bit more in the downside. So really, I think it's great to be on a panel talking about hedge funds when they've been generating a lot of alpha, and pretty optimistic going forward.
Yeah, absolutely. For the LPs on the panel, maybe you can both weigh in on what strategies are looking attractive right now or performing well within your portfolio on the hedge fund front. Do you want to start, Jose?
Sure, and just touching on the allocation piece that you brought up at the beginning, in our case at the association, our policy mix does not have hedge funds as an allocation. But we choose to do hedge funds because we are allowed to lever the fund, and so we choose to do it with an overlay. And we think it's a great use of our risk budget. We are managing through a risk lens, so we're allowed a particular risk budget. And if you target, what's attractive to us is something that is low beta. Obviously, when we use our leverage and we're constrained by a risk budget, anything we do with beta eats up that risk budget pretty quickly. And so we look to target strategies that have very low beta. Liquidity is important. It's managed by the team that also manages the treasury function. So they want to make sure that it's liquid strategies, and we have another group to do all of the illiquid strategies. So that would be attractive to us, that liquidity terms, the low beta, the combination. And we look at it because, again, from a risk lens, what you put together in the profile you assemble matters in how much risk budget usage you're taking on. So that would be the strategies that are attractive. I agree macro is one. Sometimes we put some beta in there. You can't get just pure alpha across the board, but sometimes mostly on dynamic betas, things that move around a little bit.
Absolutely. Mario, do you want to add in?
Yes. When we look at the macro backdrop, heightened inflation creates more volatility in the economy. I think that creates more dispersion in markets as well. Central bankers are a bit in the corner right now, and clearly the convergence of macro and geopolitics is kind of creating the perfect recipe for dispersion and more opportunities. Now, in this backdrop, we saw last year the 60/40 had a bit of a hard time. Where we feel we like to invest better in strategies is the more reflexive strategies that usually do well in markets where the 60/40 is not necessarily faring the best. So the strategies these are short duration strategies like macro, trend following, market neutral, strategies that can pivot quite rapidly, strategies that can change their mind to yesterday's logic. So I think that's really, really important. And obviously these strategies carry a very low beta with the rest of the pension plan. So that's another attribute that we're looking at. Our program is an overlay program, so it's a pure alpha transport. We finance it with our credit quality, so it needs to do well when the rest of the things are not doing well.
Yeah, absolutely.
I might just add
Yeah?
one thing, because we have been also talking about when you are looking at it as an overlay, which a lot of Canadian investors do. In the US, quite often hedge funds are held on just an outright basis, and so I think that is one point for 2023. Rather than looking at maybe kind of LIBOR plus 200 being acceptable on an overlay basis, because that added value, if people were targeting CPI plus 3 or 4 or 5, and then you look at T-bills at 4.5%, you're now saying, well, actually in 12 months' time, will you be celebrating if your hedge fund portfolio is up 8% and it's beaten your pension plan's actual rate of return, but T plus 4 or 5 is just going to be that much harder to beat. So that's I think a consideration at this point in time, certainly for relative value portfolios where people have felt comfortable beating some of these spreads, but having to kind of revisit. And I think there's a clear relationship between T-bills rising, the volatility that Mario spoke about, and so better opportunities for relative value opportunities, not just beta, but kind of so many different trading options that an unconstrained business model that the hedge funds represent. But we are seeing just that sort of reflection on, well, what spread is actually realistic, and some of the relative value strategies, potentially kind of a revision of some of those.
Mm-hmm.
Yeah.
And if I may add to that, Alicia, first of all, thank you and iConnections and Global Arts for inviting NAS to be a part of this. It's been mentioned strategy, it's been mentioned alpha, beta, geopolitical. The secret sauce in all of this is diversity of thought and innovation. Because if the market forces are going to be putting new and challenging opportunities before us, it requires a different approach, a more inclusive approach. Little data point, of the hedge funds that are out there, our data says that less than 10% are managed by women and minorities. Of the $85 trillion that are under management by all the different principals here, less than 2% are managed by minorities and women of color. So as we talk about strategies, as we talk about approaches, we also need to factor in how might we, from a leadership standpoint, inject what I call a secret sauce, and that's around diversity of thought, diversity of composition of teams, different approaches to have even better outcomes.
Great. I think that's a great point, and I'd love to hear more about sort of what you're hearing from emerging managers right now in the hedge fund space as far as interest from allocators goes and sort of, how they're able to connect right now.
Well, NASP being an association of about 600 members, over 120 organizations, all are minority or women-owned firms, have a series of programs and events that allows us to introduce our managers to those facilitators and those business platforms that are looking for that to be incorporated into their consideration. We have meetings with consultants where we build those relationships, which I like to term as not an ROI, but also an ROI and an ROR, return on relationships, and to expose them to the opportunities and the challenge that could bring a different perspective through our annual conferences. We're also spending time with the young professionals to build that talent base so that these companies can tap into someone who may approach the opportunity in a different lens, in a different way, but add value to the business model and to the process. So there are a number of different things that we're doing in our organizations and other organizations like Twigo, that I know John is associated with, and others out there, to really bring this relationship and expand the orbit and the universe by which this particular sector operates, not for the sake of a net sum gain, but basically to add to the value that's being presented by the wonderful models that these companies are able to produce for their clients and for their customers.
Absolutely. Mario, Jose, in the LPC, how are you thinking about incorporating emerging diverse managers, whether that's in hedge funds or privates across sort of the gamut there?
Go first.
So we don't have a mandate to do so. I know some funds have, but we have been, because of our size, we're a $6 billion Canadian plan, and given the needs that I've mentioned before on liquidity and particular alignment, we find working with emerging managers to be something that's been successful for us, and it's an ability for us to work with them early on, sometimes with founding chairs and so on, and getting a little bit more of the alignment that we want. So, obviously looking at all the spectrum, but we do like smaller emerging managers. In terms of the diversity aspect, I think even though whether hedge funds or even private space, we're not seeing too much change yet. I mean, most firms would be predominantly white-abled men. I think what we're looking at is what matters to us is the evolution. And so we're not screening out anything because that would really reduce our universe at this point, but we do give more points to more inclusive and diverse teams. And one thing I would say that is kind of disappointing when you look at it, because this has been discussed for a long time and it's not moving quickly enough perhaps, but I think there's an acknowledgement at a lot of the firms I'm finding that it's not just about going out and hiring someone of colors or a different gender. It's really creating a culture at their firm that is inclusive for those groups. Because too many times we've seen managers say, oh, well, I hired 2 women, but they just didn't stay. And you look at the firm and you look at the culture and the environment, and it's pretty clear why they wouldn't. So I think now it's becoming a little bit more ingrained in that, it's a philosophy, it's a culture. It's also successful for their businesses because more and more investors now have either a mandated or are really putting points system to this. So I'm hoping the evolution continues.
Good.
First, emerging managers. We believe in emerging managers, their nimbleness, and the things that they can bring in terms of return and everything. I think it's hard. It's hard to underwrite emerging managers, especially if they have no past track record. Let's face it, we need to go in front of investment committees and convince them and influence them in signing up. So that's one thing. We have an emerging manager program in Quebec that we are one of the main sponsor of that program. So we spend quite a bit of time on this, both on the hedge fund side, but also on the long-only side. My concern for emerging managers, more niche boutique, is sort of the rise of these multi-manager platforms who are creating these moats on attracting talent, but also technology. They may not be technology companies, but they have technology that enables their talent to thrive better, and we're seeing more and more of that. So that might be something of a heavy trend to follow, especially when you look at emerging managers and their own superpower. On diversity, this is something very important. We believe into this diversity alpha that you mentioned. We first, in order for us to manage better, we needed to measure. So all of our external funds, from private to public, which is above 100 different funds, we did some surveys. We wanted to make sure to understand what was the making of their funds, what was the diversity and everything. So we have the data now. We are going to be following this. We actually have some engagement plan with some of the younger manager for them to achieve diversity. And I should mention also, John and I have been doing a lot of work through the SBAI, and we've created this advisory group that's helping managers and allocators to better tackle that very important issue in our industry. And I told our industry was on the wrong side of the history as far as diversity is concerned, and we need to settle this once and for all.
And if I may, a footnote, it's not about performance. It's about availability, access, and capacity, because the complexity is very challenging. Robert Rabin did a report 2 years ago, the DAMI report, Diverse Asset Managers Institute, that the performance of diverse-owned firms were equal to or better than non-diverse firms. So it's not about a performance. And as John and I were talking, we would love to collaborate, to expose, to introduce, to come together to think about how do we take advantage of the moment, the movement, and the opportunities that exist out there, and create scale from a positive model that others can adopt and leverage as well.
Absolutely. I want to turn for the next couple of minutes to talk about fees. I think it's on everyone's mind right now. I know things maybe have changed for hedge fund managers over the past couple of years. So maybe, John, we could start talking about that and then turn to private markets to wrap up the panel.
Sure. And got a lot to thoughts on the diverse manager space, but I realize we're before lunch, so we've got a 5-minute clock counting down. Look, I mean, you've seen after strong performance, it's pretty hard to push back on fees. We focused 5 or 6 years ago, in the hedge fund space on trying to kind of focus on the shape of fees. And so alpha share is key. And so Mary did mention the platform funds, and there's a lot of focus around platform funds, but actually most platform funds, when they've been performing, it's a 2/3, 1/3 split. And actually when we look across other managers, a lot of focus has been on trying to make sure that investors keep 70% of the gains. And so I think that the challenge at the moment in the hedge fund space is with T-bill rates rising, if allocators haven't worked with managers to get a hurdle linked to cash, I mean, that's a real frustration in certain strategies and many strategies to pay the fees on that cash return. But it's challenging after a period of strong performance, a people focusing around capacity. So I think at the moment, actually, the biggest kind of, in terms of term progress is, we're going to see a lot more progress when it comes to on the private market side. And so what we're seeing across our client base, and more than half of our business is focused on private markets, and investors now having, I always think about it as the sort of the pendulum swings. And so coming out of 2009, 2008 into 2009, the pendulum swung, and hedge funds, you could really push back, and huge gains around governments and transparency. And in 2016, following some underperformance around fees, now in the private market space, I think what we're seeing across clients who may be allocating less because of the denominator effect, but managers are willing to negotiate, maybe even if they're allocating 10 to 20% of what they would have been previously. But from our perspective, we've seen some really big gains, but they were kind of made because of requests made by investors 3 or 4 years ago.
Right. For either of the LPs, have you seen much of a change in terms of contractual provisions and fees on the private market side, or is that sort of still playing out?
Yeah, I would say that similar to the hedge fund side, I would say the emerging or the smaller funds, easier to get some movement. The larger ones, I think that are able to fundraise in this environment and don't need to do any change are really not budging very much. The things we're seeing on the private space, we first close incentives. We've been able to get them on second close, like we don't normally do that. Size discounts are dropping to lower levels. But on the flip side, there's things that we really can't seem to get too much movement on. The AUM hard caps are increasing because the environment's difficult. So if they're able to raise a much larger fund, they are aiming to do that. And as an LP, sometimes the size doesn't line up as well with what we think the strategy can do. And the other one is the fundraising period where it's always been 12 months post first close, and we're seeing 18 months, and we can't seem to bring that back in.
Do either of you want to add anything to that?
On fees, our philosophical view is that the end saver is the taker of risk and should get the majority of the return ultimately. So what is that majority? Is it 25? Is it 65, 70, or 75%? At the same time, I also believe that fees are a market price mechanism, supply demand. What we've been seeing in the last few years, again, it's a bunch of large hedge funds getting most of the flow, I would say. So it's a very concentrated industry again, from the multi-strategy platform and everything. So the balance of power for the top brand is not necessarily on our side. In some ways, it feels a little bit like 2003, where you had a bunch of multi-strategy funds that were kind of capacity constrained. They were expensive somehow, and again, they were not liquid. Illiquidity was not liquid. So a lot of similarities there. On the private side, I think it's still early.
Yeah.
It's a different again mechanism, and I would imagine that the after period here will again see most of the larger companies get most of the inflow, which gives them a moat, and and they'll do it because they can.
Absolutely.
Alicia, I would tell you this. I mean, these three people are a hell of a lot smarter than I am, but I'm an operator. The tip of the spear is about leadership. It's taking all of the things that have been said up here and putting it in front of a team who have the accountability to make a decision of maintaining the status quo and approach things as they are, or at least inject a little bit of curiosity of what possibilities might be. And that's everything from the strategies, the approach, the composition of the team, the metrics that are put in place around performance. That's, to me, is the tip of the spear that I think will continue to propel our country and our markets to be ahead of other countries around the world.
Yeah, and I just to add to that, I think it is about the alignment of interest is really digging in, and I like the term alignment of values as well. So as you're digging into how these firms are run, and so you really kind of can see that they're harnessing the best talent to generate the best returns.
Absolutely. I think we're at time, so I think that's a great place to leave it. Thank you all for joining us, and I hope you guys all enjoy your lunch.